Okay, let's dive right in. When you think about investing, putting your money out there, you hope it grows, right?
Absolutely, that's the goal.
But there's always that shadow hanging over it. Market risk. It's the thing that probably keeps investors up at night.
Definitely. That uncertainty.
Hmm.
The chance prices could just plummet against you, wiping out gains, or worse, hitting your principal.
Exactly. So naturally, you want some kind of protection, like an insurance policy for your investments.
That makes perfect sense. You want to cushion the blow, mitigate the risk. It's fundamental.
But what if that protection isn't, well, static? What if it's not just a shield you put up once?
Right. What if the market itself, always moving, always changing volatility, demands that your strategy has to adapt constantly?
Not just setting a hedge, but actively managing it.
Precisely.
Yeah.
And that leads us right into dynamic hedging.
Okay. So it's not set it and forget it.
Not at all. It's an active, ongoing process. Continuously recalibrating your protection as the thing you're hedging, the underlying asset, moves around.
Because the market moves. Simple as that, I guess.
Well, simple in concept, maybe. But it's a pretty sophisticated approach in practice. Used by, the big institutional players managing billions, pension funds, insurers.
And options traders too, right?
Oh, absolutely. Down to individual traders working with options. It's complex, no doubt, but really powerful if you understand it.
And that's exactly what we're going to try and do here. We've got this great collection of source materials. You've shared articles, research papers, notes, covering everything from the basics right up to, well, crypto market microstructure.
Yeah, quite a stack.
So our mission really is to unpack all of this together, figure out what dynamic hedging actually is, how it works, the complexities, the costs, the real-world impact, how it helps adjust portfolio protection as markets shift.
We'll break it down. Start with the basics, what even is hedging, and then build up layer by layer, the dynamic part, the tools, the challenges, and some surprising effects it can have on the market itself.
Okay, sounds like a plan. Let's start right there. The foundation. What is hedging at its simplest?
At its absolute core, it's about reducing risk, specifically risk from prices moving against you.
Okay.
The source material, like that Wikipedia piece, makes it clear. It's not necessarily about chasing huge profits. It's more about protecting against potential losses, cushioning the downside.
So taking an offsetting position somehow.
Exactly. You take a position that should, ideally, move in the opposite direction of your main investment if prices go against you,
Right.
balancing things out.
Right, like insurance. You pay something or agree to something, that pays off if the bad thing happens, like prices falling.
Precisely. And the sources give some really good tangible examples. The classic one is the farmer.
Ah, yes. The farmer hedging wheat prices. Always a good starting point.
It really is, because it's easy to grasp. So picture a farmer. They plant wheat. They've put in the work, the money for seeds, fertilizer, everything. They're now essentially long wheat.
Yeah.
Their income depends on that wheat price at harvest.
But that price could go anywhere between planting and harvest.
Exactly. It could crash, leaving them with way less income, maybe even a loss after all that effort.
Yeah.
Big risk.
So they need to hedge that price risk, maybe using a forward contract.
That's one way. They could agree today with someone like a grain elevator to sell a specific amount of wheat at a specific price on a specific date near harvest.
Locks in the price.
It's
Gives them
certainty.
certainty.
It does give them price certainty, which is great. But, as the source points out, forward contracts have their own risks.
Right. They're not perfect.
No. What if the farmer has a bad harvest? Drought, pests, whatever. They might not actually grow enough wheat to deliver on that contract.
Ouch. Then they'd have to buy wheat on the open market, maybe at a higher price, just to fulfill the contract.
Could happen. And then there's counterparty risk. What if the buyer on the other side defaults or tries to back out if the market price drops significantly? Forwards are customized agreements between two parties.
Got it. So that's where futures contracts offer an alternative.
Exactly. Futures serve a similar hedging purpose, locking in a price for a future date. But they're different in key ways. They're standardized.
Standardized how?
Standard contract size, quality, dates. And crucially, they trade on organized exchanges, and they're guaranteed by a clearinghouse.
Ah, the clearinghouse guarantee. That tackles the counterparty risk.
Dramatically reduces it, yes. The clearinghouse steps in the middle, becomes the buyer to every seller and the seller to every buyer. They also tend to be much more liquid, easier to get in and out of than custom forwards.
So the farmer can hedge by selling wheat futures.
Right. Sell futures contracts equivalent to their expected crop size.
And the cool thing, the source notes, is they usually don't even have to deliver the actual wheat.
Exactly. That's key for hedging. Most futures positions are closed out before maturity. The farmer sells futures. If the wheat price falls by harvest, their physical crop is worth less.
But the futures they sold short can be bought back cheaper.
Precisely. So they make a profit on the futures position, which offsets the lower price they get for their actual wheat. If the price goes up, they make more on their crop, but lose on the futures.
Either way, their overall revenue is stabilized. They've hedged the price risk.
Nailed it. They use the futures market to offset risk in the physical market. Great illustration.
Okay, perfect example from commodities. Now let's bring this into the financial world. The material also walks through hedging a stock position.
Right. Let's say you, as an investor, you really like company A. You've done your homework, think they've got great prospects, maybe new product, so you buy the stock. You're long company A.
Okay, bullish on company A.
But you also realize company A is in an industry that faces broader risks. Economic downturn, new regulations, something that could hit the whole sector.
So even if company A is great, it could still get dragged down by the industry.
Exactly. So you want to isolate that company A specific bet. You want exposure to its potential success, but less exposure to the general industry or market noise. You want to hedge out the sector risk.
Makes sense. How do you do that? The source mentioned a pairs trade.
Yeah, that's a common approach, often called long-short equity. The idea is you short sell shares of another company in the same industry, company B, maybe one you think is weaker or more vulnerable to those industry risks.
So you're long the strong one, short the weak one, roughly equal amounts.
Typically, yeah. You try to match the dollar value. So let's use the example numbers from the source. Day one, you're long $1,000 of company A and short $1,000 of company B portfolio is market neutral, in theory.
Okay, set up. What happens next at day two?
Day two, let's say good news hits the whole industry. Both stocks go up, but company A being stronger maybe jumps 10%. That's a $100 gain on your long position.
Nice.
But company B, the weaker one you shorted, maybe it only goes up 5%. Since you're short company B, its price going up is a loss for you, a $50 loss on that short position.
Ah, so on day two, the hedge actually cost you. Your net gain is only $50, $100 gain $50 loss, instead of the $100 you'd have made just holding company A?
It's exactly right. On good days, for the whole sector, the hedge can feel like a drag on performance. You give up some upside.
But then, day three, the crash.
Right. This is where the hedge shows its. Imagine terrible news for the industry. Regulatory crackdown, major disruption. The whole sector tanks, say 50%.
Oof, dramatic.
Very. Now, company A, your long stock, it falls hard too, but maybe a bit less than the average because it's stronger. Let's say it drops 45% from the original $1,000. That's a $450 loss.
Okay.
But company B, the weaker one you were shorting, gets hammered even worse. Maybe it falls 47.5% from its original $1,000 value. Since you were short, that price drop is a profit for you.
A profit of 475%, 47.5% of $1,000.
Exactly, a $475 profit on the short position.
So let's put it together. Without the hedge, just long company A, day three would have been a $450 loss.
Correct. Painful.
But with the hedge,
Yeah.
you lost $450 on A, but made $475 on B. Your net result is a gain of $25 during a 50% industry crash.
Precisely. The hedge didn't stop company A from falling, but the profit from shorting the weaker company B more than offset that loss. It turned a potentially devastating loss into a small gain in a crisis.
Wow. That really highlights the protective aspect. You sacrifice some potential upside in good times to dramatically cushion the blow in bad times.
That's the essence of it. Hedging is often about survival, about managing drawdowns. And, the source makes a good practical point, finding that perfect company B to pair with company A isn't always easy.
Right. It assumes you can find two companies that behave predictably relative to each other.
Which can be tough. So a more common way to hedge the broad market or industry risk from a single stock holding is often just using stock index futures.
Like shorting S&P 500 futures against your long stock position.
Yeah, or futures on a specific sector index if you want to target industry risk more directly. They're very liquid, standardized, and represent the broader market moves. More fungible, as the source says, easier to trade than finding specific stock pairs.
Makes sense. Much simpler execution. And before we leave the basics, there was that one other slightly odd example. Hedging emotions.
Ah, yeah, the quirky one. It's less financial, more psychological risk management. The idea is betting against something you actually want to happen.
Like the sports fan betting against their own team.
Exactly. If their beloved team wins the championship, they're ecstatic. The joy of victory totally overshadows losing a small bet.
But if their team loses,
The crushing disappointment is softened a little bit by the cash they won from the bet. They've hedged their emotional downside.
a psychological cushion. Though the source did say people tend not to do this for things really central to their identity.
Right. Betting against your team in the final, or maybe against your political candidate. The feeling of betting against yourself, against something you deeply care about, seems too uncomfortable for most. But it's a neat illustration of the core hedging principle, offsetting risk extending beyond just money.
Okay, fantastic. So hedging basics. Reduce risk, offsetting positions, farmers, stocks, even feelings. Solid ground. Now, let's add that layer. Let's make it dynamic.
Right. This is where it gets really interesting, and it's the heart of our discussion today. Dynamic hedging.
Yeah.
As that Wall Street Mojo source puts it, it's not a one-off setup. It's about continuously adjusting the hedge.
Why continuously?
Because markets don't stand still. The value of the asset you're hedging changes, volatility changes, even time passing changes things. So the hedge that was right an hour ago or even a minute ago might not be right anymore.
So the goal isn't just to have a hedge, but to maintain a specific risk level over time. I think the sources kept mentioning keeping things neutral.
Exactly. That's usually the objective. Most commonly, the goal is to maintain a neutral exposure to small price movements in the underlying asset. And the technical term for that is achieving delta neutrality.
Delta neutrality, okay. Need to unpack delta. What is delta? One of those Greeks, right?
Yeah. It is. The Greeks are basically sensitivity measures for derivatives, mostly options. They tell you how an option's price might react to different factors. Delta, the Greek letter, is arguably the most important one for hedging. It measures how much the derivative's price is expected to change for a $1 change in the underlying asset's price.
Okay, so sensitivity to the underlying price.
Right. A stock, just by itself, has a delta of $1. It moves dollar for dollar with itself. A call option, the right to buy, usually has a delta between 0 and +1. A put option, the right to sell, has a delta between -1 and no.
Got it. So if I have a call option, delta 0.60. If the stock goes up $1, the option price should go up about 60 cents.
Roughly, yes, all else being equal. And delta hedging, which the SOA source mentions in that variable annuity context, is about taking an offsetting position of the underlying asset, like the stock itself, or maybe futures on it, to bring the total delta of your combined position to 0.
Total delta. You know, the delta of the option plus the delta of the hedge.
Exactly. So let's say you have a portfolio of various options, and after adding it all up, the net delta is, say, +75. That means your portfolio behaves like being long 75 shares of the underlying.
Okay, so it gains about $75 if the underlying goes up $1.
Right. To get delta neutral, you'd need to add a position with a delta of net 75. Since actual shares have a delta of +1, you would short sell 75 shares of the underlying stock.
Shorting 75 shares gives -75 delta. So +75 from the options, -75 from the short stock. Total delta is 0, delta neutral.
Precisely. And the theory, as the delta neutral source and others explain, is that if your total delta is 0, your portfolio's value shouldn't change much from very small instantaneous moves in the underlying price. You've hedged away that immediate first-order price risk.
Okay, that makes sense for right now, but why does it need to be dynamic? If I'm delta neutral now, why can't I just sit back? Why the constant adjusting?
Great question, because delta itself isn't static. It changes.
Delta changes what?
It changes primarily as the price of the underlying asset moves. It also changes as time passes. That's another Greek, theta. And as volatility changes. Vega. But the big one driving dynamic hedging is the change in delta due to price moves, and the sensitivity of delta to price moves. That's measured by another key Greek, gamma.
Okay, wait. Delta is price sensitivity. Gamma is the sensitivity of the sensitivity. How much delta changes when the price changes?
You got it. Gamma tells you how much your delta is expected to shift for a $1 move in the underlying. Options, especially ones that are at the money or close to it, can have significant gamma.
I think I see it now. So even if I start perfectly delta neutral, delta equals 0, if I have positive gamma, as the underlying price starts to rise, my delta will increase, maybe become positive.
Right, you're no longer delta neutral, you're now effectively long.
And if the price falls, my delta will decrease, maybe become negative, making me effectively short.
Exactly. So to stay delta neutral, as the price wiggles around and gamma causes your delta to shift, you have to keep trading the underlying asset. Buy some if delta goes negative, sell some if delta goes positive, always trying to bring that total delta back to 0.
That's the dynamic engine right there, the constant buying and selling to fight the changing delta caused by gamma.
That's the core of it. And it's crucial, as we'll discuss later, that if you have negative gamma, like if you've sold options. Dynamic hedging forces you to sell the underlying as prices fall and buy as prices rise, trend-following behavior. Some strategies even aim for delta-gamma neutrality to reduce sensitivity to these delta shifts from bigger price moves. The KTH source even shows how you calculate the profit or loss on all those little rebalancing trades.
So dynamic hedging is this constant adjustment, mostly around delta and gamma, trading the underlying to stay neutral. How does this stack up against the simple static hedge we talked about earlier, like just buying a long-term put option?
Yeah, the Wall Street Mojo source contrasts them well. Static hedging, simpler, more stable perhaps. You put on a hedge, maybe buy that put, or short some futures and largely leave it. Rebalance, maybe quarterly or annually or not at all. Lower maintenance.
Okay.
Dynamic hedging. It's all about flexibility and responsiveness. By adjusting constantly, it aims for a much tighter, more precise hedge against minute-to-minute price moves. In theory, it keeps you closer to that neutral target through all the market's twists and turns.
More precise, more responsive, but all that continuous adjusting, the buying and selling, that sounds like it could get really expensive in the real world.
Bingo. You've hit the absolute nail on the head. That is the critical practical challenge. Dynamic hedging is expensive.
Why? Just trading fees.
It's more than just commissions. Every time you rebalance every trade, you face transaction costs. Brokerage fees, yes, but also exchange fees, and crucially, the bid-ask spread.
Ah, the difference between the buying price and the selling price.
Right. You always buy slightly higher at the ask and sell slightly lower at the bid. With frequent trading, those tiny spreads add up incredibly fast. It's a significant friction. That KTH source even mentions academic work focused specifically on optimizing delta hedging with transaction costs, trying to minimize the replication error, the gap between the perfect theoretical hedge and what you actually get after costs.
So how often you rebalance isn't just about tracking the market better, it's a direct trade-off with how much you're paying in costs. Which leads us perfectly to that SOA study, the one asking, how often should the hedging portfolio be rebalanced?
Yes, that's a fantastic piece of research because it puts real numbers on this trade-off. It looks at a huge, real-world problem. Insurance companies hedging variable annuities or VAs.
VAs often have those guarantees, right? Like a minimum value guarantee.
Exactly. Things like guaranteed minimum accumulation benefits, GMAs. The insurer basically promises the policyholder a minimum account value even if the market tanks. Effectively, the insurer has sold a complex, long-term put option. They've taken on massive market risk.
And they use dynamic delta hedging to manage that risk, often based on models like Black-Scholes.
Typically, yes. But Black-Scholes, as the study points out, assumes you can rebalance continuously, frictionlessly, costlessly. A perfect world that doesn't exist.
So the study tested more realistic frequencies?
This did. They ran massive backtests using decades of S&P 500 data, 1970 to 2017, simulating the hedging of these VA guarantees. They compared 4 different rebalancing rules.
Okay, what were they?
Daily adjusting the hedge every single trading day, weekly every 5 days, monthly every 21 trading days, and a move-based approach, only rebalancing if the portfolio's delta drifted by more than a set amount, like 0.05.
Interesting comparison. So what did they find initially without transaction costs factored in that perfect theoretical world?
Well, even then it wasn't straightforward. It depended on the time period. For hedges related to contracts maturing before 1990, daily rebalancing actually best resulted in the lowest hedging cost or error. But for contracts maturing after 1990, especially more recently like 2008, 2017, monthly rebalancing often performed better. The move-based strategy was kind of middle of the road, less consistent.
So even theoretically more frequent wasn't always better. It depended on the market regime of the time. But the kicker comes when they add costs, right?
This is the crucial part. They calculated the trading volume, the turnover for each strategy, and daily rebalancing. It generated about 4 times the trading turnover as the monthly strategy.
4 times the trading.
Wow.
Then they applied a realistic transaction cost estimate, 0.25% of the value traded on each rebalancing trade. Small percentage, but applied to massive volume.
It adds up fast. So what happened to daily's performance advantage from before 1990?
Gone. Almost completely erased, as the study puts it. The sheer cost of trading every single day wiped out any theoretical benefit it might have had in that earlier period.
That's incredible. So the friction, the cost of actually doing the dynamic hedging fundamentally changed the conclusion. Absolutely. The study concluded that once you factor in realistic costs, there were essentially no 10-year periods in their entire 47-year backtest where daily rebalancing was significantly better than, say, monthly. Sometimes monthly was better, sometimes weekly, sometimes daily was okay. But the huge theoretical advantage of hyper-frequent trading just wasn't there in practice.
It really drives home that more isn't always better. The optimal frequency is a complex balance between tracking accuracy and cost efficiency.
And it likely depends heavily on market conditions, how volatile things are, and the specific transaction costs you face.
And doesn't this also highlight the gap between elegant models like Black-Scholes and messy reality? Black-Scholes assumes smooth, continuous markets.
Exactly. The SOA source touches on this too. Real markets have stylized facts that violate those assumptions. Fat tails, for instance, extreme events happen way more often than a neat normal distribution predicts.
Right, like market crashes.
Yeah. And volatility clustering. Periods of high choppiness tend to stick together, and calm periods stick together. It's not the constant predictable volatility the basic model assumes. These real-world features mean that applying theoretical models directly, without considering costs and market realities, can lead you astray, as the rebalancing study shows.
Okay, so dynamic hedging is powerful, but practicality bites back hard through costs and the lumpiness of real markets. It's not a perfect shield. Now, let's shift perspective slightly. What happens when lots of people, big institutions, are all doing this dynamic hedging dance together? Does managing your own risk potentially create risk for everyone else?
Now we're getting into the systemic effects. And yes, this is a major area of research and concern. That Institute for Statistics and Mathematics source really digs into this, the potential for dynamic hedging in aggregate to actually be destabilizing and increase market volatility.
What's the mechanism there?
Remember how basic delta hedging often works? To stay neutral, if the price falls, you often end up having to sell more of the underlying asset to rebalance your delta. And if the price rises, you often have to buy more of the underlying.
Selling when prices are falling, buying when prices are rising. Hang on, that sounds like trend following or momentum chasing.
It behaves exactly like that. And imagine if not just one player, but a significant chunk of the market, big banks, hedge funds, insurers, all running similar dynamic hedging programs, are all forced by their models to sell into a falling market or buy into a rising one at the same time.
Their combined selling pressure could push falling prices even lower, and their buying could fuel a rally.
Precisely. It creates a potential feedback loop. The hedging activity itself starts to influence prices, pushing them further in the direction they were already heading. This can exacerbate market swings and amplify overall volatility.
So the very act of trying to reduce individual risk when done collectively can increase systemic risk.
That's the paradox. The source explains that if these program traders have a significant market weight, their collective demand, driven by hedging needs, can distort equilibrium prices. Volatility stops being some constant background noise, as in Black-Scholes, and actually becomes dependent on the price level and time. Volatility itself becomes dynamic, partly driven by the hedging activity.
Wow. And does it matter if other people know this is happening?
Yes, expectations play a huge role. The source cites work showing that if other market participants anticipate this forced selling by hedgers when prices drop, they might try to sell ahead of them or withdraw liquidity, making the price impact even worse. Beliefs about market liquidity are key. If everyone fears liquidity will vanish, the hedgers' forced trades have a much bigger splash, amplifying volatility.
It's like a crowded theater effect. Everyone knows the hedgers have to get out or in, and that knowledge changes behavior.
Exactly. It's a complex interplay. Now, interestingly, despite knowing about these feedback loops, many practitioners still use models like Black-Scholes because they're tractable. But they might try to account for this self-generated volatility.
How?
By using a higher input volatility in their models than what they currently observe in the market. The source calls this concept super volatility.
Super volatility, like an inflated guess.
Sort of. It's finding an input volatility number that's high enough so that the theoretical hedge calculated by the model would cover the option payoff, even accounting for the extra volatility the hedging itself might create. It's like building in a safety margin, acknowledging your own potential market impact. It might mean slightly over-hedging initially compared to a naive model.
Hedging against your own hedging, that's recursive. Is there anything that dampens these destabilizing feedback effects?
Yes, and this is a really important finding from that source. The key mitigating factor is heterogeneity.
Heterogeneity, meaning diversity in the things being hedged?
Exactly. Think about all the options or other derivatives being hedged in the market. If they're all very similar, same strike price, same expiration date, then their deltas and gammas will all change in roughly the same way when the underlying price moves.
So all the hedgers will need to trade at the same time in the same direction.
Right. concentrated selling or buying pressure. Homogeneity amplifies the feedback loop.
Right.
But if the derivatives being hedged are very diverse, lots of different strike prices, different maturities, then their sensitivities are spread out.
So some hedgers might need to buy while others need to sell, or they need to trade at different price points or times.
Precisely. The rebalancing needs are dispersed. The collective market impact gets smoothed out. Heterogeneity in the derivatives market acts like a shock absorber, mitigating the destabilizing potential of aggregate dynamic hedging.
So counterintuitively, a more complex and varied derivatives market might actually be more stable in this regard than a simple uniform one.
It's a fascinating implication. The structure of the market matters just as much as the strategies being employed.
Okay, so dynamic hedging. Powerful, costly, can create feedback loops impacting volatility. But diversity helps. We've seen this in traditional markets. How does it translate to the Wild West of, well, crypto? That Cornell paper looked into this, right?
Yes, crypto is a fascinating laboratory for these ideas. High volatility, evolving market structure. The Cornell paper asked, can traditional market microstructure metrics actually predict price dynamics in major cryptos, Bitcoin, Ether, Solana, etc., in ways that would be useful for dynamic hedging?
Market microstructure. Remind me what that is again.
It's basically the nuts and bolts of trading, how orders are placed, how trades happen, the rules of the exchange, the behavior of buyers and sellers at a very granular level. The microstructure metrics try to quantify things from high-frequency data, like how much liquidity there is, how wide the bid-ask spread is, the size and frequency of trades, imbalances between buy and sell orders.
Stuff that gives clues about the underlying supply, demand, and maybe informed trading.
Exactly. And the paper's big finding. Yes, these metrics do have predictive power in crypto, even using machine learning to find patterns. They could predict future volatility and price changes.
So crypto markets aren't totally random walks. The way people are trading contains information.
It suggests that, yes, similar to traditional markets, the trading process itself leaves footprints that can offer clues about future short-term moves, which is obviously super relevant if you're trying to dynamically hedge.
Were there any specific metrics that stood out in the crypto context?
Two came up repeatedly as important predictors: the roll measure and VPI.
Okay, roll and VPI, what do they measure?
The roll measure is basically a proxy for the effective bid-ask spread, how much it costs you just to buy and immediately sell. It's derived from how prices bounce back and forth between trades, so a measure of illiquidity or transaction cost.
And VPI.
VPI stands for Volume Synchronized Probability of Informed Trading. It's more complex, but it tries to estimate the likelihood that trades are happening because someone has an information edge, what they call toxic flow. High VPI suggests maybe informed traders are active, potentially predicting volatility spikes.
So how expensive it is to trade, roll, and how much informed trading might be happening, VPI, can actually predict future crypto prices and volatility.
That's what their analysis suggests, and that's directly useful for hedging. If roll is high, maybe you rebalance less often to avoid costs. If VPI spikes, maybe you anticipate higher volatility and adjust your hedge size or strategy accordingly.
Did they see if trading in, say, Bitcoin could predict moves in other coins, like a ripple effect?
They did look at cross-market effects, and they found that microstructure metrics from Bitcoin and Ethereum, especially roll and VPI again, were significant predictors for price changes and volatility in other coins like XRP, Solana, and Cardano.
So BTC and ETH really do seem to lead the pack, even at the microstructure level.
The findings support that view, yeah. Their trading dynamics seem to spill over.
And did these relationships break down during the crypto winter, the big downturn, or did they hold up?
That's a key test of robustness. They specifically checked the period from late 2021 to mid-2023, which included that major slump. And they found the predictive power of these metrics, these relationships, remained stable.
That's significant. It wasn't just a bull market phenomenon.
Right. It suggests these microstructure dynamics are pretty fundamental to how these crypto markets operate, regardless of the overall trend.
So even in a market as new and different as crypto, tools and concepts from traditional finance, like microstructure analysis, still provide valuable insights for complex strategies like dynamic hedging. Fascinating bridge.
It really is. It suggests that while the assets change, the underlying mechanics of trading and price discovery might share more common ground than we sometimes think.
Okay, we've covered a huge amount. The concept, the mechanics, costs, frequency, market impact, crypto applications. Before we wrap up, were there any other related risk management ideas in the sources that offer a slightly different angle?
Yes, the KTH source briefly touched on the comparison between value at risk, or VAR, and conditional value at risk, CVR. VAR is probably the most common risk metric you hear about.
Right. VAR tells you the maximum loss you expect, say, 99% of the time.
Exactly. Like our one-day 99% VAR is $1 million, meaning we're 99% confident losses won't exceed $1 million tomorrow. But VAR has issues.
What kind of issues?
Well, one big one is that it's not always sub-additive, meaning the VAR of a combined portfolio could actually be higher than adding up the VARs of the individual pieces. That's weird because diversification should reduce risk, but VAR doesn't always reflect that properly.
Okay.
And the other issue is VAR tells you the threshold, but it says nothing about how bad things could get if you cross that threshold. It ignores the tail risk, the severity of those rare extreme losses.
So CVR is supposed to be better?
It addresses those points. CVR, sometimes called expected shortfall, is sub-additive, so it reflects diversification benefits. And critically, it measures the expected loss in the tail specifically, the average loss you'd expect, given that you've already breached the VAR threshold.
So it quantifies how bad the bad outcomes are likely to be, on average.
Exactly. It gives you a better sense of the magnitude of tail risk.
And how does this relate back to hedging strategies?
Well, the KTH source mentioned a study comparing dynamic hedging strategies. One strategy aimed to minimize CVR, directly targeting and reducing that expected tail loss. The other was a more standard delta-gamma hedging approach.
And what was the takeaway from that comparison?
It found that the CVR minimizing strategy performed better specifically in high volatility environments and, interestingly, for minimizing smaller losses too. However, the traditional delta-gamma approach tended to produce higher expected returns overall.
So different approaches optimize for different things. CVR focuses purely on limiting the worst-case scenarios, even if it costs some return potential.
That seems to be the trade-off. It highlights that risk management isn't monolithic. Are you trying to smooth out all bumps, delta gamma? Or are you primarily concerned with surviving the catastrophic event, CVR? The best strategy depends on your specific goals and risk tolerance.
Makes sense. Different tools for different jobs. And wasn't there one more source, Gyrostat, talking about specifically targeting tail protection?
Yes, their approach sounded distinct again. They described using proprietary systems, maybe looking for pricing anomalies, to provide specific protection against large market moves, the extreme outcomes, the tails, both big crashes and big rallies, potentially.
Protecting against big moves up and down, that sounds like it would cost a fortune.
The source acknowledges it has a cost, definitely. Buying that kind of protection, especially for rare events, is like buying expensive insurance. But the idea they put forward is that the strategy is designed to generate much higher returns during those big tail events, enough to hopefully compensate for the premium paid during calmer times.
And they mentioned ways to potentially fund that cost, like selling options.
Right. They noted strategies like writing, selling call options, could be used to generate income to help pay for the downside protection, like buying puts. Of course, selling calls caps your upside if the market truly rockets, so again, there are trade-offs.
So it's an active management of the cost of tail protection itself, trading potential mega gains for crash protection.
It appears to be a very focused strategy on managing those extreme risks, aiming for non-correlated absolute returns within defined risk limits, based on their description and track record claims. It's another flavor of dynamic risk management, but very specifically targeting the tails rather than continuous neutrality.
Really shows the diversity out there, from broad hedging to delta neutrality to CVR minimization to specific tail protection. Lots of ways to approach risk.
Absolutely. The landscape is complex and varied.
Well, this has been quite the journey. We really went deep. We started with that basic idea of hedging, just reducing risk, the farmer, the stock pair trade. Then we jumped into dynamic hedging, that constant adjustment, driven by the Greeks like delta and gamma, trying to stay neutral.
Right, that continuous rebalancing act.
Then we hit the practical realities, the huge impact of transaction costs, how rebalancing frequency isn't straightforward, learning from that SOA study that more frequent isn't always better once you pay the bills.
Friction is real.
And then the really fascinating systemic stuff, how dynamic hedging itself can create feedback loops, potentially amplifying volatility, how the market knowing about hedging changes things, concepts like super volatility, and how diversity in contracts heterogeneity can actually be a stabilizing force.
That interplay between strategy and market structure.
We even saw how these sophisticated ideas apply in new frontiers like crypto, with microstructure metrics offering predictive clues. And finally, we touched on alternatives like CVR for tail risk focus and specialized tail protection strategies.
It paints a picture of dynamic hedging, not as some magic bullet, but as a really powerful yet incredibly complex and active toolkit. Its success isn't guaranteed. It really hinges on skillful execution, managing those costs diligently, having a deep understanding of market dynamics beyond the simple models, and even being aware of the market structure like liquidity and who else is hedging.
It's definitely not a passive strategy. It's a tool for navigating uncertainty, not eliminating it.
Exactly. Maintaining a desired risk profile in a world that's always changing.
So, thinking about all this, what's the final thought for you, our listener? Dynamic hedging, it's born from complex math and finance theory, sure, but it's not just theory, it's real actions taken by huge players, constantly interacting with the market, potentially reshaping the market itself. Now, think about our world, increasingly digital, faster, more connected. Algorithms are executing these dynamic strategies minute by minute based on floods of data. How does this growing prevalence of automated, responsive, dynamic hedging change the game for everyone? Big institutions, small investors? All of us. What does this constant, often hidden dance of rebalancing mean for market volatility, the stability we think we see in the financial system we all depend on? Something to definitely keep in mind as you watch those market charts wiggle. There's a lot going on beneath the surface.